So next, this is our last panel of the day. Actually, wow, time flies. But it's going to be our 2021 outlook. What are your predictions for next year? And with the last panel, Jason Copeland couldn't make it, but I promised a Southerner to come drop knowledge for us. So we're going to have Joe Wade, who's getting on screen as we speak. Joe is the CIO, I believe, of hedge funds and CTAs, but I'll let him correct me, at Brown Advisory, which is like 90 billion, some small number like that. And joining Joe, we have Mike Dumid, who's the head of Dorset Management. They are about to launch a natural resources fund. So we'll give us a little outlook on commodities there. And then Dave Klusendorf, our CIO at Typhon. Hopefully his connection's a little bit better than earlier now. But gentlemen, Mike, could you unmute and kind of guide us through this panel?
All right, gentlemen, thank you. It's been an interesting day. I haven't been able to attend all the sessions, but certainly lots of opportunities have been proposed from various panelists, including this last one. But we're going to have a little bit of a shot at the outlook. You know, what we're faced with right now is a rather interesting regime paradigm, if you will. We have stocks reaching all-time highs, interest rates all-time lows, heavy fiscal and monetary support, and that leads to, as we all know, potential bubbles. This trend may not be sustainable, and if you're an asset allocator, you know that bonds can't perform the way they did before if equities decline. So there's a lot of opportunities for the kind of traders and hedge fund managers in this kind of a space. So let me, Joe, why don't you say a couple of words about what you're up to, and you know, we'll each spend a minute on that, and then we'll talk about the question of, is diversification dead?
Right. Well, I've been with Brown Advisory for the last 3 years. Baltimore-based firm, about 95 billion in client assets. Assets are very well diversified. Majority probably in stocks and bonds, but a lot of private equity investments and a fairly large amount in, I would call them, trading activities, whether they be hedge funds or futures-related activities. But we serve a pretty broad client base. People are looking for and what their concerns are today, and those are things we can talk.
Okay, David, you've been in the background throughout this whole set of sessions. Why don't you just say a couple of words about your role there, and then we'll.
Well, I'm a partner in the firm, and I would say my primary duty is evaluation of external managers, really of all types. But I'm also involved in overall asset allocation and probably representing the more trading-oriented strategies as we deal with committees.
Right. Okay.
And I have to argue against the guys that come from the traditional side of the world.
And David, just say a couple of comments.
I sit as Chief Investment Officer at Typhon. Really, I sit on our investment committee, but also the one that evaluates. I'm the beginning of the pipeline. I evaluate all sorts of trading strategies and traders that come into Typhon, you know, put them through our grinder to see if they fit our model of non-correlated sorts of programs so that they can all play well together. And then, you know, the risk, the execution around it, you know, any sort of problems with that. And it's been an incredibly rewarding occupation, you know, getting to know our guys, getting to bring some of the guys in. It's been fabulous.
Good. Well, you've got quite a diverse portfolio there too. And with Dorset, as James was kind enough to say, we're actually starting a new fund, but we've been managing a multi-strategy portfolio for quite some time, focused on discretionary specialist traders, each one coming out of the physical markets with an edge of information edge, managed with separately managed accounts. So we're focused on absolute return, extracting alpha from commodity market volatility. Anyway, Joe, let's go back to you and on this question. You're sitting around, as I used to do at Silvercrest, with a bunch of people who think 60-40 is the the miracle solution, and you're trying to convince them that diversification is important and it's not dead. What do you find effective in trying to get people to look over to the alternative space?
Well, the definition of effective is something we'll have to talk about, because someone who comes from the traditional world, it's pretty hard to get that philosophy. But I think that the biggest problem that the traditional investment world has today is the low level of interest rates, combined with the fact that interest-sensitive investments are not going to offer the diversification benefits that they have in the past.
Right.
Because simply if 10-year rates are at 60 basis points, unless you go negative, you're just not going to get any positive impact on performance. Now, you may get some portfolio volatility dampening, but you're not going to get any positive performance of any magnitude to offset a significant equity market decline. So things that I've been involved in is, in addition to looking at a number of trading strategies, that they could be in futures, they could be in equities, but they either have low correlation or low beta to equities. So we're looking at those kind of things. But we're also looking at and have been investing in some what would be considered more private equity orientated investments, but real estate activities where there's some yield component to it. Actually recently invested in some MLPs, despite the fact that they're very out of favor. Infrastructure funds are getting a lot of interest in royalties. You saw Bob Dylan sold his music catalog for $200 million or so, and I'm sure that was an income-oriented investor that was the buyer of that. But the biggest emphasis has been on finding trading strategies, people that have low net exposure equity strategies or futures-related strategies that have really strong negative correlation benefits.
Right. Well, and David, you're screening a lot of managers in the future space. I guess you could say that there's probably been no lack of interesting opportunities. We're certainly on our side looking at trading traders that have unique aspects to their programs that aren't correlated with stocks and bonds. Can you comment on that, David, just in terms of what you're seeing in terms of the volume of activity that's popping up in that space?
I would say our volume of activity has been pretty constant, in my almost 6 years here. We tend to have really good traffic. What is interesting is the niche, the uniqueness of some things that come to us. I'll give an example of someone that knows a delivery system really well. It's not an incredibly complex set of steps, but if you don't understand the minutia of it, you can definitely hurt yourself doing it. So, now you have something that's very niche-y that can't be exploited by, a quant-based formula or, a hunt and seek program. So this kind of sets itself apart, and that makes it unique. And then the structure of it does too. Right up to different ways of looking at, parsing data, looking at it that way. How do you go and attack, certain markets? It's been interesting to see, it become more of a two-way street, though. You know, Mike, they're asking me my opinions about a lot of things they're doing, and if they're on the right path, right? Because they're just on the start of their path. That's what we do. You know, we find these types of traders. So, you know, they're looking for some guidance too, which, you know, we're always more than happy to help with.
Yeah, it's interesting that, and we're seeing the same thing, that a number of these uncorrelated niche traders or strategies, they're going to be capacity constrained at lower levels, which for people like you, Joe, you know, makes it more difficult because you have to monitor a broader range of managers. In fact, it enhances the structures that David, you're working with and what we're working with, where we can accommodate a large number of low capacity strategies into a multi-strategy program that has capacity. I guess, Joe, due diligence becomes a little more burdensome then, right? You have to follow a lot more people.
Yeah, absolutely. I think we monitor around 100, 125 different strategies. We do invest in some commingled vehicles where someone like your two firms are, you know, can identify things and provide, in a lot of cases, the business structure that these niche traders need to have to be successful. And frankly, it makes our job a lot easier because it's sort of a full-time job of trying to find people who are really good at these niche things. You know, one good thing is we haven't had, you know, a large enough percentage of our clients adopt the diversification yet. So we're probably still in good shape now, but, you know, if you get a long equity bear market, which we haven't had, only the three of us can probably remember, you know, I think you'll see more and more demand, which is going to make returns that more difficult to achieve.
Yeah. Well, and so one of the big issues is that and when you have these very trendy markets like we have now, you get a lot of crowded trades.
Right.
And so it's those kinds of trades that when a regime change happens, whether it's the equity markets tipping or people start to get concerned about unanticipated inflation, and we'll come back to that, then you get these mass moves, and then it's a game a little bit like the musical chairs game. You better have a chair to sit on when the music stops, or you're going to be in bad shape. So taking a careful look at where the crowded trades are and where that fits into your portfolio, and making sure that there are some opportunities. I mean, even if you can find instances where your expectation is different from where the market's expectation is, and where the pricing is attractive in a non-crowded space that would work well in a regime change. That's the kind of niche strategies that I think people need to look for.
Absolutely. I think the velocity of the movement of money is so much higher than historically in our careers that things move really quickly. I mean, you can just look at the movement of the stock market, different sectors in November, and certainly banks have been out of favor, and energy companies out of favor, and industrials out of favor, and energy stocks went up 30% last month. So once there's a trigger, things can move very, very quickly. And I don't think we've seen the rush of capital necessarily into the commodity market that we could see 21, 22. I mean, you could just look at Bitcoin and see the volatility of Bitcoin. And apparently we had a big buyer 2 or 3 months ago and ran Bitcoin up to 18,000. And I think today it was, at one point it was down like 500 points today. So money moves very, very quickly.
Yeah.
Well, it's an interesting thing. You know,
Yeah,
it's
go
an
ahead,
interesting
David.
thing, Mike. You know, when I look back on, you know, let's look at, was it 2018 when volatility really just kind of collapsed, right? And it was a whole
Yeah.
year. You know, I look at it as, you know, and I'll use a term that we can relate to. It's either the expansion or the contraction of the tape. So you have the old ticker, and when it was really busy, lots of prices come across the tape ticker, right? And you would see this crowding of it all, right? Because there's more activity. So you would see 5 days crowded into a day, and then you would see the opposite. You know, I think of the VIX fall off of, you know, like this move just took forever, right? So, you know, you would see in a day, you know, stretch out over, you know, a longer period of time because there wasn't much movement. So it really become an exercise for us of listening to our clients and what they need in a structure and what they're looking for, so that we can put those little pieces together for them and make sure it behaves in the way that it needs to behave for them. And I think, you know, Joe put you know, a nice little touch on it and said that should make their due diligence and their monitoring a little easier right along with it.
Yeah. Well, we talked about some tactical trading concepts here. Maybe we can focus on a couple of areas that look to be interesting in the coming year. I have some thoughts in the commodity area, but Joe, you know, give us a couple of interesting areas that you've run across here. I mean, you got the royalty issue was one of them. Buying to life settlements is probably another one, but go ahead.
Right. And, you know, it's really, you can go after some of these things and get some extra yield, but you definitely give up liquidity and you take duration risk. So when you go into some of these kind of investments, you're tying your money up for 3, 4, 5, 6, 7 years, which is, you know, counter to the kind of approach I've had over the years where we, you know, what the futures offer and stocks to some degree as well is ability to have instant liquidity. So there's a trade-off there, but you can earn a little bit additional. In terms of what opportunities I see going forward is, I'll talk about a couple of really big picture things. And one is, I think there is a global movement away from the dollar as the main means of transaction of goods and services. I mean, it's probably in its infancy, but it seems to be slowly building momentum. I think the rise of Bitcoin is, you know, one sign of that, and the fact that a few large transactions have been transacted in gold. But I think that, you know, we in the dollar has certainly been weak recently, but I think you could see that weakness continue. The U.S. has provided probably more stimulus than any other country, and depending on how the January Georgia election goes, it could even be massively higher. So dollar weakness, which would be strength in gold and perhaps strength in commodities in terms of dollar prices is, you know, I think a trend that could really work in the next couple of years.
Let's just stick with this one for a second, because the weakness of the dollar and the other big issue I'd like to get back to is reflation, inflation kind of thing. I agree with you on the dollar, and I think this is a major opportunity set going forward. A couple other factors that should help the dollar go down or weaken the dollar is that there was a huge inflow into U.S. equities in this last year. And when you look at the amount of that from the Japanese institutions and others that was hedged, it's very low. And that's because the cost of hedging was quite high for some of these countries. This is expected to change. And so if those hedging programs start building up, that will help the dollar go down. And also, when you look at the real yield on U.S. Treasuries, 10 years, it's -1.
Yeah.
And in China, it's +1.5. So and their interest rates at 10-year yields are more like 3%. So there's a draw for people who are willing to look at the renminbi as a possible appreciating currency, given their faster growth, recovery from this pandemic, et cetera. So I think there's a number of fundamental factors, and as you say, Joe, that leads to weak dollar. Also, it helps commodity prices, emerging market currencies, emerging market equities, bonds, et cetera. And I'm sure, David, you're seeing some of that in the trading people that you're talking with as well, right?
Sure. I mean, that's really where I cut my teeth, was with interest rate trading, and it was one of the first trades that I ever learned. And not to be confused with what we would think of an option box, but you have two currencies and two interest rates tagged to them, like they're inherently related to each other. And there are arbitrage opportunities in those days, not so much anymore, to keep that relationship in line. So yes, it can have a profound effect on the way everything, rolls along. The thing with the U.S. Treasury curve right now is, I think a lot of it is going to really be correlated to what type of fiscal policy and what type of legislative policy is going to come out of D.C. In the next 3 to 4 months. I think it's going to have a profound effect on it, or could. It's probably more cautious.
Yeah. Okay. So I think that this is one big opportunity going forward. Joe, you had some others on your list.
Well, I'll make one more comment about that. Most people don't pay that much attention, but there's an emerging market Asia ETF, and it recently made a 5-year high in the midst of COVID, and which is somewhat surprising. We still got a global slowdown, but so if things really pick up economically, you could see some interesting things going on in Asia, which is somewhat related to the weak dollar prediction that we have. I think this is contrary, not a subject that most futures people deal in, but there is an opportunity, I think, for futures traders. And, I think back to the years 2000 to 2002, and we saw the largest rotation between growth and value and big and small equities, certainly in my lifetime. And, I believe we're, at an inflection point, maybe past an inflection point in some of these relationships, because I saw an interesting statistic today that the Russell 2000, which includes a lot of small stocks, has actually outperformed the S&P for the year. And up until 3 months ago, this was a large cap only thing. But I think what has happened is the difference between growth and value, large and small, has gone to extremes that we haven't seen since the late 1999, early 2000 period. And it's really hard to predict when these things are going to reverse. But just like you said, Mike, when it does reverse, it can move very, very quickly. So I think the things that are, you've got 3 things working together. So you've got a series of equities that have worked because of COVID, like Zoom and other stocks like that. And you had a lot of companies that have been hurt by COVID and the slowdown in the economy. And with the vaccine, that may reverse itself. Secondly, we saw a statistic that small stocks are selling close to the lowest 10% of their price earnings ratio over the last 30, 40 years. And large stocks are selling closer to the highest PE level that they've ever sold for. That's a pretty big extreme. And then you've got growth and value, which growth is at an extreme we haven't seen since late 1999. So with the recovery of the economy and the change in the impact of COVID on us, you could see you know, a big reversal in these relationships, which offer some tremendous trading opportunities, spread trading opportunities, if not outright positions for people who like to trade stock indexes. It's also going to have an impact on, you know, if the movement is as big as we think it potentially could, it could have a big impact on currencies as well as interest rates too.
Mm-hmm. Okay. David, let's talk about a couple of opportunities in the short-term tactical trading area. From our point of view, I'll just name a couple areas that we think are going to be interesting and provide good trading opportunities. You know, we just had the last panel talking about grains. We've shifted a lot more of our emphasis in the last year over to the grains area, just because of the high demand of, you know, from China, from their drought and the hogs and weather-related issues from La Nina, et cetera. So those are going to be volatile commodities, and I think that's a good opportunity set for traders. In the metals area, iron ore is in strong demand, but the supply potential from the big players like Rio Tinto and BHP, as that comes online a little bit more, it's quite likely that those prices will drop again. So there's good trading opportunities in areas like that. Copper looks like it's on a bullish move, you know, from demand and supply side. Low capex on and COVID issues in generating enough copper coming out of the ground and large demand. So I think there's a bullish trend there, and then we think natural gas has got some volatility. People think it's
yeah, just a little bit over the last week and a half, 2 weeks.
Yeah, right. One day, and of course it's always the last day of the month, right? When these things happen. Yeah. But you know, warmer weather on the demand side is cutting demand, and you know, you got drop in oil production, so it's soft short term. People think bullish longer term. So there's looks like some good opportunity sets in the commodities area. You're probably seeing that too, David.
Sure, and it really comes back to one of our, you know, bread and butter fundamentals. When you're talking about extreme volatility, especially, you know, you're not talking about trading euro dollars or, you know, something on the interest rate curve where there's plenty of volume there to get things done. These things can really skid one way or the other. You really have to take into consideration your time frame of your trade and then the type of volatility regime that you're trading up against. And if you can't start there and construct a trade properly from those two basic fundamentals, I don't see, you know, Rufus was talking about, like, how do you discern luck from skill? You know, if you can't grasp that concept, you're falling into the luck category, in my opinion. So it really starts with some of those basic things of, hey, you know what, you have this idea, that's great. You know, tell me what you are. I always use the example of, if you came to me and said the S&Ps are going up 100 points, 100 handles, and it's going to happen in the next 3 hours, there's only one thing we can do, and that's buy some futures. If you're going to tell me it's going to take a year, we'll never survive the volatility storm, right? Eventually, we're going to be stopped out of our position because there's just going to be too much movement. So, you know, that's really kind of where it has to start, with this craft part of it and learning how to do that. And there's lots of ways to get that done, right? Whether if it's by an analytical thing, you know, firsthand observation, there's a lot of different pathways to it, but that's where it starts. And you're right, but there's going to be plenty of these opportunities in the commodities markets over the next year to 2 years. They're just going to present themselves in a big way. You know, you got to remember, a lot of these commodities have gotten beat up. They've gotten beat up. And so now, you know, everything in its cycle.
Yeah. Well, and Joe, you were talking some big picture items. We got a few minutes left here. I think one of the issues that people need to reckon with is the potential for inflation. And the interesting aspect of this is that you don't actually have to have the inflation show up to have the markets move. It's the anticipation of inflation that sends gold prices up, that sends the interest rates moving, and you may never even get the inflation because that move in itself could cool things off. but the chances of having an unanticipated inflation worry, imagine what that can do to bonds. 1% extra inflation, and you put that premium on top of bonds, you've got some real problems. What do you think, Joe?
Well, absolutely. When my career first started, it was when inflation was out of control. And one of my great mentors, Doug Kitchen, who was NFA vice chairman for many years, I remember going to his place, and he had a refrigerator that was acting up a little bit, but it wasn't ready to be put to bed. He went and bought a new refrigerator anyway and put it in his garage because he knew it was going to cost more down the road. And so I do remember when those inflation expectations were at the front of people's mind. And, as you said, we have negative interest rates now. The Fed has been upfront in saying that they're not going to do anything about inflation until it exceeds 2% on average, which means they would allow it to go, even higher than that. And, I would agree with you wholeheartedly that it's just the change in the way people think about things that triggers the movement of money that causes the spurt in commodity prices and changes psychology. And once it changes, it can change for a long time, as we've seen over the years. The deflation camp has been here for a good while.
And David, with your background in interest rates, imagine with an extra 1 or 2% on the inflation expectation, what that would do to the long end of the curve.
Yeah, it would move it just a little bit. I can't imagine what the ultra bond, an on the run product would do. It would be the most volatile part of at least the CME suite of derivatives. We did a really good job this year in preparing for COVID, and our managers, were able to really capture some of that, especially long end of the curve. Really from a price perspective, rallying. Now we could possibly see that reversal. So I don't think an outright position would be something that would be appealing to me. I would be looking at something along, of some sort of ratio spreads coming down the curve to see what you could capture. And once again, like last with the trade, right? You want to be able to last to see it come.
Yeah.
No one's got the crystal ball if it's going to happen tomorrow.
Right.
Yeah. Think about how many people have bought 10-year bonds at 85 basis points or 30 years at 1.5, who don't expect to hold them for that period of time, but hope to be able to sell them when rates start going up. So you could have a massive amount of sales that hit simultaneously that could really be a problem just at the time when we're issuing an exceptional amount of debt, and it could even go higher with another massive COVID package.
And to link this back to some of the earlier points that we were talking about, is diversification dead? If you're worried about, let's say, these tech stocks, or you're worried about bonds, if you put in a hedging program that shorts the tech stocks or goes short the bonds, and you have to hang on to those positions for 6 months, you're going to bleed to death, right? So you really have to find some other way to hedge that, not by hedging the actual instrument, but finding something that's not correlated that can give you a potential benefit down the road. And when you look at the volatilities in these markets and the correlations, the way they're priced, if you can find something that you think would be uncorrelated when the market is pricing in a hefty price for correlation. Somebody gave me this example. Typically, when the Japanese yen, when the Japanese stock market goes up, the yen is going down. There's that that mix has always been the case for the last several years. So that correlation is priced in. But if you think there's going to be a regime where the Japanese yen will go up and the Japanese stocks will go up, you could price in the opposite of that correlation, which would be very inexpensive, and have a hedge that would capture what would happen if the regime changes. So trying to find creative ways to, take advantage of the correlation markets or the vol pricing is where some of these traders can come in with some bright ideas and give us some diversification.
We showed clients a chart that 20 years ago, to earn a 7% return, you had a very simple mix, equities and fixed income. And 10 years ago, it was a little bit more complicated. And today, you've got to have a broad spectrum of things that are uncorrelated to have a chance to make that kind of return with reasonable risk.
Right. So I think we're getting up to the 4:45 target date. I expect to see James' head pop up here. But as any closing remarks, I mean, we didn't talk a lot about the politics, and I don't think that we necessarily have any special input on that side. But that's obviously one risk that's out there. Anyway,
for sure.
James, I think we've covered a lot of good topics here, and I think it's time to turn it back over to you.
You guys were wonderful. Thanks for bringing it home today. I appreciate the uniformity and look too. It's a good trio. I mean, we do love diversity at Typhon, but sometimes homogeneity is great too. But you're all good friends. I really appreciate you doing the panel, closing things out today. You all have rain checks for me for steaks and cocktails when we could get together in person. So make sure you claim those once COVID is off the radar.
We have to come to Miami, huh?
Yeah. You guys, I mean, we'll do some stuff in New York and London too, but I mean, Miami is pretty preferred. I mean, let's be real. I mean, we are freezing today. It's about 50, but it's one of the worst days of the year.
We just had some snow here in New York. I mean, it was a couple of flakes.
Yeah, no thanks.
Yeah.
I just want to be someplace I can hustle a little golf. That's all.
You could hustle some golf here. It's a nice uncorrelated revenue stream to our
we'll come
our
to
trading.
Texas is 70 here in Austin, and we've got Mr. Musk moving down here, so things might get really interesting.
I'll try to visit before he gets there. I don't know if he and I get along, but one of my good friends from New York just abandoned his Upper East Side condo and is en route to Austin as we speak. So I'm gonna have to give him some housewarming, get you some barbecue, Joe. We'll make it a productive trip.
All right, gentlemen, thanks a lot for the panel.
Awesome,
we
guys.
enjoyed it.
Okay.
Thank you, everyone.
Thanks. Good to catch up.
Thank you.
Good.